Hello and welcome to Accounting Dictionary. The term for discussion is share warrants, and in this session we'll see the detachable share warrants. Warrants are the financial instruments which gives the holder the right to acquire shares at a certain price within a certain stated period. And sometimes these warrants are attached to another instrument, say bonds, to make these bonds more attractive. And invariably these bonds are detachable instruments. That means the bonds can be traded in the market as well as the warrants can be traded in the market as a standalone instrument. So at the time of issuing the bond, we have bond as an instrument, another instrument called share warrant. Let us take an example. Suppose A Limited issued 6% 1000 bonds of 1000 at 105, and each bond was issued with one detachable stock warrant which gives a right to buy one share. The market price of the bond after the issue was 998, and the warrant itself had a market value of 50 per warrant. So 1000 bonds were issued with an attached detachable stock warrant. So we have to value the bond, and we also have to show the value of the warrant on the date of the issue. So the steps to be followed is find the market value of the bond, find the market value of the warrant, find the ratio of the bond value to the market value. Let us take this example. So we have seen that there are 1000 bonds of 1000 issued at 105. So the issue price is 105. The face value of the bond is 1000. The market value of the bond is 998, and the market value of the warrant is 50. So therefore the total market value of the bond is 998,000, and total value of the warrant is 50 into 1000, 50,000. So the ratio of the market value of the bond to the market value of the warrant is 95% and 5% respectively. So the issue price of the bonds has to be distributed between the bond and the market and the warrant in the ratio of the market value. So the issue price of the warrant, the issue price is 1.005 million, will be distributed between the bond and the share warrant in the ratio of the market value of the bond and the market value of the warrant. So the value of the bond on the date of issue is 9.57 or 9,57,052, and the value of the warrant is 5% of that, so of 101,05,000, so 47,948. So the bond 1 million 10 lakh value of the face value of the bond is said to be issued at 9,57,052. So there is a bond discount. So let us see how will this appear on the balance sheet. So we are getting cash of 105,000. Cash will increase to the extent of 105,000. Bond will be shown at the face value. The share warrants will appear as an equity at the value. So the bond will appear at the face value. The share warrants will be valued at the price determined. The cash will increase to the extent of the money raised, and the bond discount is the face value, the bond value minus the face value. So there is a bond discount of minus 42,000. 948. The capital remains same, the retained profit remains same, creditors remain same, no change in the debtor and no change in the stock. So let us recap. The bond will appear at the face value. However, the value of the bond, taking into consideration the price and the market value, the value of the bond is 95,000. See, unamortized bond discount reduces the value of the bond, and share warrants will continue to appear till the date the shares are issued, and once the shares are issued, share warrants are cancelled and converted to capital. So share warrants will appear on the balance sheet on the sources side, and when the equity is computed, it is added to the capital, retained profits and the share warrants. And when the share warrants are converted into capital, that means when the bondholder exercises this right, then the share warrants becomes the capital. And over the period of the bond discount is amortized over the life of the bond. Thank you very much.